What's going on, team, and welcome back to another video. So today's topic is going to be on time frames. I already have a separate video briefly explaining what time frames are, but in this video I'm going to go more in depth of how you can utilize the time frames, as well as explain the importance of top-down analysis. So really quick, for those that don't know what time frames are, the stock market allows us to view candlesticks in different time intervals. Now what that means is, let's say you're looking at the chart here, and you are looking at all of these candlesticks. Each candlestick on the chart represents a specific time interval. Now, this time interval in specific is the 15-minute time frame. And the best part about this is you can look at any time frame of choice. It doesn't have to be the mainstream time frames that a lot of people use. Also, one thing to know about time frames is that lower time frames are just a micro scale of a bigger time frame. So let's take a look at this example here. You can see on the left-hand side, we have a 15-minute candle, and on the right-hand side, we have 3 5-minute candles. Now, when I say a lower time frame is just a micro scale of a higher time frame, this is what I mean. As you can see, within the same 15-minute candle, there are 3 5-minute sessions. So when you're looking at that 15-minute candle, you can see the high point is here and the low point is down here. But now when you're looking at the same 5-minute session, you can see it's not just one candle, but it's now divided up into 3 different sessions. You can see that same 15-minute high is here and that same 15-minute low is here. So now taking a look at a live example with the 1-day time frame. If we mark out the high and the low of our daily session and now drop down to a 1 hour, you can see that that entire daily session is composed of 24 hourly time frame candles. Again, because there are 24 hours in a 1-day session, this is why there are 24 hourly candles in that same 1-day session. So now that you understand that concept, here is a universal law that I need you to write down into your notebooks. That is that higher time frames will always outweigh the lower time frames in terms of direction. Let's say, for example, you expected this daily time frame to continue selling off. So knowing that the daily candle should sell off, if you're trading on a 5 or 15-minute time frame now, you know the direction should be favoring downside and not upside. Why? Because the daily candle is favoring lower. And remember, a smaller time frame is just a micro scale of a bigger time frame. So again, if the bigger time frame is expecting lower, you should be favoring short setups on lower time frames. This is why traders get caught up in losing trades, because the higher time frames are going in a certain direction, but then they're countering that direction on lower time frames. So when you're thinking of entering a new trade, always keep the higher time frames in mind. Now I want to talk to you a little bit about top-down analysis. What this means is that you are doing all of your charting on a higher time frame first and then making your way down to the lower time frames. You should never start your charting on a lower time frame first and then make your way up the time frames. You should always start a fresh chart on the highest time frame possible, then work your way down looking at levels on lower time frames. So now that you know the difference between top-down analysis and different time frames, I challenge you to implement this into your live trading and live charting. But with that being said, if you have any further questions on this video, always reach out through the Discord community or message me privately.